Okay, so it's recording the lecture right now, and that will be available after this session. First of all, I was thinking about this unit, trading in modern financial markets, and I've taught this unit for a very long time. I've taught it for many years. And when you hear the word trading in modern financial markets, what do you actually think about? Well, of course you hear the word trading, and what is trading? And to me, some people think about trading as a game. It's fun, it's entertaining. You can potentially make profits, whether they be unrealized or realized, and it can be, and it can be interesting to understand how a particular security moves through time in terms of its prices and how you can potentially exploit that. But if you think about trading as a game, then in order to play that game well, what do you need to do? So the first thing is, how do you play a game and know that you're performing well in that game? Well, I indicated it to you that you play the game generally to make a profit. So a lot of people trade because they think they can easily make a profit. Now, that profit, the larger that profit is, the better the person is winning in that game. Now, profit can be either realized or unrealized. Now, the idea of the realized profit is that you have bought and sold something, and there has been a positive cash flow that has come to you in the form of profit. Now, unrealized profit is that you may have bought something, but you yet have to finalize the other part of the transaction, that is selling it, in order to secure that positive cash flow. So that's unrealized profit. Now, the question is, what are you playing the game for? Are you playing the game to make a realized profit or unrealized profit? Then the question becomes, well, how quickly do I want to make this realized or unrealized profit? Do I want to make this profit within a matter of seconds, within a week, within a month, within a year? So time frame is important to understand. And then the question is, so as a profit motivated individual, you have to determine what sort of time frame you want to indeed make this profit. The second thing that you have to think about is what particular market you want to trade in. What security are you interested in? Are you interested in trading companies by trading their stock? Are you interested in trading derivatives, which are a risk management tool, which helps to mitigate the risk when you trade that particular stock or underlying asset? Are you interested in trading in gold, silver? So that could be a commodity. Are you interested in trading? There's so many different securities that you can trade. Are you interested in trading cryptocurrency? Are you interested in trading currencies? What particular security are you interested in trading? And when you decide on what security you may be interested in trading, then you have to have an intimate knowledge about how that security will move in terms of price over time. And how to get that intimate knowledge is that you have to understand the factors that affect the security's price. Generally speaking, information affects prices. And so there are various different types of information that you have to assess when you trade. You have to think about macroeconomic information. You have to think about information specific to the security. If you're trading an equity security, you might have to think about what is the health of that particular company by looking at the financial statements of the company, that is the balance sheet, the profit and loss statement, the cash flow statement. So understanding the factors which help influence the information that can have an impact on the securities price is very important when you trade. Because at the end of the day, trading is pretty much simple. It's very much simple until you start trading. The idea behind making that realized or unrealized profit is either one, buy low, and then two, sell high. I mean, that's quite simple to understand for anyone in this classroom. Or the second is one, sell high, and then two, buy low. If you do any of the reverse, then you're going to make a loss, and that's not enviable, or not something that is the ultimate goal if you are a profit motivated trader. So that's important to understand. So I just wanted to give a bit of a spiel to begin with, and then we'll just start talking about this particular site. So for those of you who are enrolled, you'll realize that on this Canvas page, there are various different points that you need to be aware of. So the main one being the announcements. So you always check the announcements to see whether I've put something there or one of my tutors has. The modules. In terms of the modules, you'll notice that you have already on this module, Rotman Interactive Trader, some documents that you can download and have a look at. And it allows you to get a better understanding of it. I'm going to provide another video by the end of this week to go through Rotman Interactive Trader and to allow you to understand how to log on to it before the classes officially start, so you get a better awareness of how to do that. And if there are any technical issues and glitches in connecting, then you can let one of my tutors or myself know. In terms of week one, I've already put the first set of lecture slides for week one, which you may have already downloaded. And for each of the weeks, week one, week two, and onwards, I've already provided you with the relevant readings that you need to try to get through before the start of the week. So the idea here is week one, we've got the official textbook Teal 2018. In fact, it's chapter 1, Introduction to Securities Trading and Markets, and we've got another textbook by Harris, Why People Trade, chapter 8. Now, we'll go through the textbooks a little bit later in terms of administration, but in terms of the tutorials start next week. So there was a person on Ed Discussion Board, which is here. Ed Discussion Board is an ability to post to either me or to anyone else in the classroom. Doesn't seem to work for me, but the idea is that students can post. Okay, that's what happens when, okay, sorry about this, give me a moment. Ed Discussion Board, when I'm logged in, doesn't allow me to have a look at it, but there was a student who posted a question saying, when do tutorials begin? They begin next week. And the tutorial questions will be provided in the module. So by either today or tomorrow, the tutorial questions will be provided to you. So you can hopefully address those in the classroom. In terms of the unit outline, you can see here the unit outline for either face-to-face or remote, effectively the same. If you click on that, it provides you all the relevant details in relation to what we cover in the unit. The Zoom link allows you to come and connect onto me, and that's about it. That's all I need to say in relation to this. So what I'll do is I will continue the discussion. So I began this class by talking about trading as a game, and talking about in order to play the game well, in order to secure profits, you need to have an intimate understanding of how information can affect security prices. And then the question becomes, well, where do we get information from? So generally speaking, if you're a trader who is actively participating in the market, then you need to have a particular routine to try to determine what's happening in the market right now. There are various different websites that you can go to, and some of you have already been to these, that allow you to understand what's happening in the world today. Information changes constantly, dynamically, and that has an effect on a multitude of securities in terms of their valuations. So by way of an example, a routine that you might decide to follow is you might decide to say, okay, well, Reuters.com is a website that allows me to have a look at what's happening in the world today. So for example, Pelosi arrives in Taiwan, vowing US commitment, China enraged. So the idea is that political risks can have an effect on security prices. And what is the effect of Pelosi coming to Taiwan? You might want to click on, within Reuters, you might want to click on markets. And within markets, you have various different markets. So we talk about modern financial markets. And there are so many different markets to have a look at: Asian markets, carbon markets, commodities, currencies, emerging markets, European markets, and so forth. So there's a whole lot of information that you need to process in order to determine how any information signal that you might be finding in the news and how that information signal might affect your security price that you might be interested in trading. You might want to look at, for example, local news. So in Australia, the local newspaper is the Sydney Morning Herald, at least in Sydney. And in terms of the Sydney Morning Herald, it has local news that might affect local traded securities. So one of the things to be aware of is that how we determine, and you would be familiar with this, how we determine how a particular market is performing within a country is by looking at an index. So for example, in Australia, we have the All Ordinaries Index, we have the S&P ASX 200, we have the S&P ASX Small Ordinaries, many different indices exist. And these indices provide an indication of how well the local market in terms of the stock market is performing. So by way of example, the S&P ASX 200 is produced by Standard & Poor's, the credit rating agency. The ASX represents the local stock market in Australia, being the Australian Securities Exchange, and the 200 represents the top 200 stocks by market cap. Now we can see that this index is now 6998.1, so it's increased by 5.10, and so that is an indication that the market has slightly gone up, which is a positive thing. So that's something to be aware of. An index or market index provides an indication of how well the financial markets are performing right now. Now the question then becomes, how do we trade? Well, generally speaking, most people trade online. So if you're interested in a particular security, you can buy it on an online trading platform. You can use a traditional broker, but you can also buy it on an online trading platform. Locally, one of the trading platforms that you can use is CommSec. There are many other platforms to use. Now, CommSec in Australia represents is an acronym for Commonwealth Securities. So Commonwealth Bank of Australia set up CommSec, so that's why it's called Commonwealth Securities. And the brokerage commissions are very small. So, for example, the brokerage commission on Commonwealth Securities right now is $0 for the first 10 trades. So you have to look at the conditions and so forth, and that might encourage people to join this particular e-broker or e-broking engine, which allows you to buy and sell various different securities in Australia and elsewhere. If you want to trade securities around the globe, you might be interested in joining Interactive Brokers. So Interactive Brokers is, again, another online broking platform, but it's global in nature. It's set up by a US firm, and it tends to be one of the cheapest places to trade in relation to the amount of brokerage commissions you would need to pay when you trade various different securities. So Interactive Traders is one example, Commonwealth Securities is another. So on that note, let's talk about the administrative side of this particular course. And then let's say by 11 in the morning, what we'll do is we'll have a break for around up to 10 minutes, and then we'll resume the rest of the unit. So with that said, I'll just have a bit of a reminder to all of you that if you don't mind, for those who are still off mute, if you don't mind muting your Zoom, because that will mean that there'll be less background noise. So I think Martin might still be on not mute. Thank you, Martin. Okay, so let's start. So the idea is that for the first up to about, let's say, 11 o'clock, we're going to do part 1 and part 2. So we're going to be doing an overview of this unit, and we're going to be doing trading basics. So let's do it. So the structure, as you know, it's a 2-hour lecture, 1-hour workshop. Generally speaking, the lecture material will be available a day before the lecture as I update it and so forth. And the lecture generally is 2 hours in length, though it may be less sometimes. But generally speaking, I go through the full 2 hours. If anyone has any questions in the lecture about material that I cover, please either interrupt me or during the break, ask me questions. I don't have any problem whatsoever answering students. And that's the reason why I wanted to do this lecture live as well, as questions naturally come up when we go through material. The tutorial workshops are 1 hour in length. Most of the tutorial workshops are covered in Zoom, though, as I said, there are some face-to-face classes. 5 of your tutorial workshops will be based on Rotman Interactive Trader. As I said, Rotman Interactive Trader is a trading simulator, and the idea of doing the trading simulator is to learn key topics. Is to learn key topics based on as close to real life trading that we can do without actually paying money for it. The teaching team is me. I'm the unit coordinator. As I said, I've done this course many years. The University of Sydney was primarily involved in market microstructure as a research topic. Market microstructure is, just imagine, is putting a microscope against the markets and getting a detailed examination of how security prices are formed or discovered in markets, and understanding what information signals affect security prices. So that's what market microstructure is about. So I've been teaching this for at least a decade or more, and so I'm pretty aware of a lot of things. The head tutor for this unit is George Isa, and he'll be the first point of contact if you have any issues that you'd like to discuss. And other tutors include Duke May, Jessica, Andriel, and Tasbia, very experienced tutors that can hopefully make this course a heck of a lot more interesting for you. The unit learning outcomes, as I said, if you're seriously interested in trading, then you want to really have a key idea of what are the factors that affect a particular security's value. Always observe how that information changes security values and trade accordingly to try to make a profit. That's it, right? That's what you would be interested in as a trader. So that's what we're trying to do. We're trying to teach you how to understand the game. So you need to understand the rules of the game, and two, understand the information signals that affect the prices of those securities. Now, most traders will have no idea as to whether, if there's a positive information signal, most traders will understand that that security price is going to go up. And conversely, if there's a negative information signal, most traders will understand that security price is going to go down. We don't necessarily understand the specific price increase or the specific price decrease that will occur, but we generally know the direction. Now, if you know the direction, then potentially you can adopt simple or sophisticated trading strategies to try to capitalize on those price changes and hopefully secure yourself realized profit. Now, are companies interested in how information affects their value? Of course. As you know from corporate finance, the main goal of a company is to maximize its value. So given that main goal, most companies tend to be publicly listed. And given most companies are publicly listed, they can be significantly affected by price changes in their stock that is trading on a particular exchange. So of course, companies want to make sure that their price hopefully either increases or is stable. No companies want to have their stock where their prices are very volatile, because that indicates the risk of the company is higher. And sometimes when the risk of the company is higher, that scares potential investors from putting money towards the company. So that's something that companies don't want. So they're also interested in how the prices of their securities are changing over time. As I mentioned to you before, we're also going to introduce you to the RIT, or Rotman Interactive Trader, which I'll talk about a little bit later. Now, the prescribed textbook is Teal 2018. Now, the download link here, you can press it. I'm not going to press it right now, but that will allow you to go to the University of Sydney Library, and you can download the entire textbook electronically and start reading ahead in relation to the relevant chapters that I've suggested you have a look at. So this is the main textbook, the Teal 2018. The Harris 2003 is a supplementary textbook that I would certainly suggest that you download. The University of Sydney allows you to download up to 263 pages for free, and that basically allows you to download certain sections of the textbook which are relevant for this unit. Yes, it's a 2003 textbook. Yes, I know we're in 2022 right now, so you might think, this textbook is old, it has old statistics, who cares? Well, think about this textbook like the Bible for trading. The Bible is old as well, but the idea is it's still relevant for a lot of people in 2022. The idea is that this textbook, I'm not akin to the Bible, provides you with a general theme, which allows you to understand how trading works in various different markets. Now, the topics covered are a number of topics, and you can have a look at these later. But the idea behind these topics is that I want you to be familiar with the game. I want you to be familiar with the institutional background. I want you to be familiar with all of it, because in order to perform well in the game, you have to understand the rules of the game very well and understand the motives of yourself and also different traders that you would trade against. What are my expectations? My expectations are pretty simple. I want you to learn. If you don't know any material, I want you to investigate that more and have greater independent thought with learning particular topics in a more detailed way. And I want you to bring any issues that you have to either me or the tutor that you have, so that when you have tutorial sessions, it will be more interactive in nature, and we can talk about what's happening in the market right now, as opposed to talking about what happened in the market 20 years ago. That's not really that important from the perspective of getting more interested and engaged in the unit. So stay on top of the material. So make sure you read the textbook. Make sure you read come to the lectures. Be very proactive in classes, and potentially one of the ways to be very proactive is interest in the topic helps effective learning. So read what's happening in the real world. For example, have a particular routine where you wake up in the morning and you've got on your smartphones the app for Reuters or the app for Bloomberg or the app for the local newspaper, and read what's happening in the real world to get an information about what new information is coming about that may shape and affect how people trade in various different security markets. come prepared to class. Or even, if you're not already, if you don't already have an account with one of the online brokerage engines, such as CommSec or Interactive Trader Brokers, why don't you set up an account and perhaps start trading shares? When you set up an account to most of these online trading brokers, you don't have to pay any money. So you don't have to do anything like that. So you're not doing anything like that. But by getting an account, you can get more information about prices for securities, financial statement data for securities. So a lot of these online broking engines like CommSec and Interactive Brokers provide a lot of information that you can have a look at later. So my expectations is that you learn. I don't think that's hopefully I don't think that's hopefully don't think that's a far-fetched expectation. That you need to, all of you are here to learn, right? So hopefully you can learn. And my job is to make sure that you learn well and that you're interested in that particular journey over the next few weeks. That's it. So I had a question from Zatul, I just noticed. eToro company with whom actually we place the order, is it directly to the market? Yeah, so for example, eToro is like an online broking website. So for example, when you like CommSec, for example, that I showed you, or Interactive Brokers, eToro is very much similar. Now, the idea is that these offer you the ability to send your order directly to the market. So you can't send your order directly to the market. So for example, if I wanted to trade a company which trades on the Australian Securities Exchange, such as BHP, BHP trades, is publicly listed on the Australian Securities Exchange. If I wanted to buy or sell BHP, I couldn't send my order directly to the Australian Securities Exchange to buy or sell BHP. I would have to send my order through one of the financial intermediaries. That financial intermediary could be CommSec or Interactive Brokers or eToro. So eToro has the necessary connection with the ASX for you to send your order directly to the ASX to buy or sell BHP through eToro. Okay, so that's hopefully answers your question as a tool. Okay, now in terms of the assessment is everyone's always interested in assessments, right? So yeah, we have exams. Yeah, that's just to test your knowledge, right? So the in-semester exam or the mid-semester exam is multiple choice questions. It's held in week 8. It's worth 30%. So hopefully all of you do well. The assignment is going to be a trading report, which is linked with Rotman Interactive Trader, which we'll discuss very shortly, and that's worth 20%. It's a group assignment, so there's around 4 to 5 people that will be part of your group for that assignment. People who can be part of your group can be anyone in the class, but ideally it might be beneficial to form a group within your own tutorial stream, because then at least you know that the students that you form a group with will be in that tutorial and you can have a discussion with them at that time. But you can form a group with whomever. The final exam is worth 50%. Now, standards-based assessment, we know that everyone, I would like to give everyone a high distinction in this class. But the reality is that not everyone gets a high distinction. Everyone will get some range between a pass and a high distinction, and some people, unfortunately, will get a fail. I hope no one gets a fail in this semester. But whatever the case is, my hope is that you are very interested in this unit and that you will and you will get a great mark. That's it. I just want you to do your best, and hopefully that best will be reflected in a great mark. Okay. In relation to the grading, I also want to say something which is very, very important. Academic integrity is really important. This course is taught every year, and there are some students in this course that are still going through academic integrity because they were found to potentially have cheated in their exams, and they still haven't got their marks. And those students that have got their marks, some have basically been given a fail. Even like let's say a student who was on a distinction, right, now has a fail because they were caught out cheating. Okay, some students who were on a distinction also were caught out cheating, and some students were decided that they would get that their mark would be capped to a 50% pass because they were caught out cheating. So my point is, do not cheat. Please do not cheat. The university has sophisticated software to detect this, and the university is fully aware that there are companies out there that you can send the questions directly on a real-time basis to these companies, and the companies will give an answer very quickly back to the student. The university is very aware of this, and please don't be tempted to do that. It's a bad reflection on you, and it's not something that we encourage. 4 to 5. We'll talk about the group a little bit later. 4 to 5 students within a group. I'll answer the other administrative questions that I'm getting on the chat window, possibly after the end of the hour session. Assessment. Okay, so for the tutorial workshops, please note that let's say there's 10 questions that I give you for the first week. The tutor isn't, I've told the tutors, don't expect to go through all those 10 questions. I don't want you to go through all those 10 questions. I want to make the class interactive, interesting. So the tutor might only discuss 1 or 2 questions and try to create class discussion around those 1 or 2 questions. But then you may be asking, what about the solutions to the 8 other questions that we didn't go through? Well, all the solutions will be provided at the end of each week. Those solutions are just general solutions. It is very important that you answer all these questions in detail, as they will help you prepare well for the mid-semester and final exam, and that's for you to do yourself. There'll also be consultation sessions outside the normal tutorial sessions where you can ask other tutors for help and clarification if required. As I said, the tutorials begin from week 2 onwards. The assessment components in detail. Rotman Interactive Trader, as I said, is an online simulator which simulates an order-driven market. And our idea of Rotman Interactive Trader is for you to better understand trade execution, arbitrage, and market making. They're interactive classroom discussions, and there will be 5 of those Rotman Interactive Trader sessions. Now, they start in week 3. Now, I'm going to encourage you to start trying to log on to Rotman Interactive Trader by the end of this week. So I want you to start logging onto it so that if there are any technical issues, then you can let us know and we can fix them before week 3. I want you to be able to log on, go through the various different understandings of how to submit an order through Rotman Interactive Trader, so we don't have to answer these questions in week 3 and we can fully engage in week 3. Now, is Rotman Interactive Trader important for you to understand? Yes, because it's going to be part of your group assignment. So you have to have a good understanding of Rotman Interactive Trader. And 2, to incentivize all of you, at the early next year in January, there's international competition, Rotman Interactive Trader, where it's held in Toronto. And the idea behind that competition is that students from top universities around the world compete. And it's quite the honor to get a high ranking in that competition, as it reflects well on your team, reflects well on the business school, reflects well in your CV, where that helps you hopefully get a job. No, there are no tutorials this week. Tutorials begin next week. That's to answer Kong. Now, in terms of the mid-semester exam, I said it's held in week 8, closed book. Final exam, it's held in the final exam period. The final exam I haven't yet determined. I'm thinking this is going to be 4 questions, which are short, medium term to long answer questions. And that's all I'll say. So let's begin. Part 2 of this unit. So part 2, we're going to be talking about what are markets. Now, all of you should have a general understanding of what markets are. Now, generally speaking, are markets important? And the answer is, I think so. Markets are very important. Markets allow you to buy and sell various different types of securities. And when we talk about financial markets in particular, financial markets facilitate the flow of funds between borrower and lender, right? So the idea is that lenders have money and borrowers need money right now. So the idea is that financial markets are important to act as an intermediary between borrower and lender in order to ensure that there's a smooth flow of funds between those 2 groups of individuals. When there is a good flow of funds between those 2 groups of individuals, then economies can flourish and economies can do well. When there is a blockage in that flow of funds, then economies tend to deteriorate and tend not to do well. So it's very important. It's a very important role that financial markets play. They facilitate the flow of funds. So it's very important to ensure that there is a healthy flow of funds between borrower and lender. Now, when we talk about financial markets, we can split financial markets into various different groups. We can talk about stock markets, debt markets, money markets, foreign exchange markets, commodity markets, and so forth. And the important thing here potentially is to distinguish financial markets from capital markets. Now, capital markets is effectively debt and equity capital markets. So most of you would be familiar with stock markets, right? Most of you would be familiar with your local stock exchange that most countries will have. So as I said, in Australia, we have the Australian Securities Exchange, where you can trade companies which are publicly listed on that exchange. In Japan, you've got the Tokyo Stock Exchange. In New York, you've got the New York Stock Exchange. So most countries have one stock exchange, or one primary stock exchange, where you can buy and sell local securities which are trading on that exchange. And a way to describe stock markets or equities trading on stock markets is by using the acronym ECM, Equity Capital Markets. Okay. Now, in some markets you can trade debt. In terms of fixed income or debt, they can include government bonds, they can include corporate bonds, and a whole variety of different types of debt securities. Now, the securities that trade in debt capital markets, like securities that trade in the equity capital markets, have a maturity of greater than 1 year. Now, both DCMs and ECMs can be grouped and called capital markets. Okay, so capital markets allow you to trade debt and equity. It allows companies and other institutions to raise money as well. So capital markets. Now, we also have money markets. Now, the differentiating feature of money markets is that securities that trade on money markets tend to have a maturity of less than 1 year. And that can include currency and coins or deposits. So money markets tend to have securities with less than 1 year in terms of maturity. Foreign exchange markets, as the name indicates, trades various different types of currencies. It's one of the biggest markets out there, where in terms of value, in terms of the daily value of trades that occur in currencies, the foreign exchange markets is the largest. And then you've got commodity markets as well. Commodities being, for example, gold, silver, and other types of minerals. There's many more other markets out there, but financial markets effectively group all what we have below. And then we have capital markets, which group DCMs and ECMs. All securities have a different risk and return profile. And so depending on what security you want to trade, you might want to trade a particular security because it's more risky, more volatile. So therefore, the price of that security is going to change more quickly over time. And so you might have a preference for trading that type of security. Whilst if you're more of a long-term investor, you might prefer to trade a security with a lower risk return profile so that you have a certain level of stability in relation to trading. Now, securities can also have other names to describe them. Sometimes securities are described as instruments. Sometimes securities are described as assets. So these words are interchangeable. Now, one of the things that you might be aware of for those who have studied derivatives is that financial markets, if you group all financial markets together, they can also be referred to as underlying markets or spot markets. So I'm going to write that down, in fact. So spot markets can also be referred to as underlying markets. Okay. Now, when we talk about derivative markets, derivatives markets provide you with the ability to manage your risk when you trade in the underlying markets. Okay. So for those who understand. Those who understand derivatives would understand what I'm talking about pretty well. So as an example, by way of example, let's say I am trading a stock, BHP, on the Australian Securities Exchange. So I'm trading the stock BHP. Let's say the stock is currently trading at $10, and I'm concerned that the stock might go down in value where I'm going to make an unrealized loss. So let's say I'm concerned that I'm going to lose when I start trading BHP. So let's say if the stock were to go to $9.80, I'm making an unrealized loss. So I might want to protect myself or hedge that unrealized loss by buying a derivative product on BHP. So if I buy a derivative product on BHP, then if the price were to go from $10 to $9.80 in the underlying market for BHP, I don't make any loss because I've got a derivative on BHP. So the derivative on BHP gives me protection. Now, you might straight away say, Well, Ruben, that just makes sense. I would buy derivative all the time because I want to protect myself from making losses. But derivatives, like insurance, come at a cost. Come at a cost. Insurance is costly. So when you buy a derivative, you're paying extra. And so when you have a derivative on, let's say, BHP, when you make money, let's say BHP goes from $10 to $10.50, you've made money on BHP, but that money, that gain might be offset by the cost of the insurance that you pay to protect yourself against a potential loss on BHP. So it's important to understand insurance can be important, but insurance is costly, which can offset any potential gain that you make when trading a particular security. So that's something to be aware of. Now, to give you an example, let's say BHP is trading at $10. Let's say to buy the derivative on BHP might cost me, let's say it might cost me 50 cents. Okay. So the derivative is a security that changes value over time, and that derivative changes value in accordance with how BHP is changing in price as well. So the derivative changes value over time as well. Now, if you recall, I said, let's say BHP is $10 and the derivative on BHP is, I said 50 cents. Now, the question is, well, some people now choose to trade derivatives solely as opposed to trading the underlying asset. And the reason is that there's a cost difference. If I buy BHP, one share of BHP, that's going to cost me $10. But if I buy one derivative security, that's going to cost me 50 cents. So the idea is that you might not have the outlay to spend $10, but you might have the capital to spend 50 cents. And so the idea is that a lot of people now trade derivatives solely, where they can realize a potential gain with less outlay. So that's called leverage. So you're able to obtain a larger gain from a smaller initial outlay by buying and selling derivative securities. Okay, so I hope that makes sense. Now, the question about how prices are formed. Now, in relation to how prices are formed, when we talk about price formation, we're talking about another word for this is price discovery. So another word for how prices are formed is price discovery. Now, at the end of the day, we know that with any market, we've got price on the vertical axis, we've got quantity on the horizontal axis, and we've got a demand, and we've got a supply curve. And the intersection between the demand and supply curve gives us our equilibrium price, or our true price of that security. And that will be the market price of the security. So prices are formed from a dynamic demand and supply schedule. And the demand and supply schedule can be elastic or inelastic. So you would have learned this in economics. And the demand and supply curve is interactive in the sense that information will change the demand and supply curve, based on new information events that arrive for that particular security that you're trading. Now, remember in corporate finance, we said that the price of a security is based on the present value of its future cash flows. So let's talk about BHP again. So there are various different information signals that come about in relation to BHP. Now, those information signals will constantly change the future cash flow of BHP. And remember, when we discount the future cash flows, we discount it by the cost of capital. Now, the cost of capital for BHP will be affected by how the systematic risk of BHP changes. So the cost of capital also dynamically changes because the risk of BHP dynamically changes. So by definition, yes, Zatul, individual investors, sorry, I should have, sorry, as I'm talking, I'm seeing the chat window. Can individual investors participate in derivative markets? Yes, but you have to sign a disclosure and you have to say that you have understood the risks of trading derivatives, because they have to be more understood. And can students who choose, yes. If you either are CC or RE, you can form a group together, no problems. Okay, so coming back to information affects future cash flows, information affects risk, information affects a whole lot of things. And remember, I told you market microstructure is basically market microstructure is basically understanding how information effects or information events affect security prices. It's the process by which an investor's latent demands are ultimately translated into prices and volumes. Now, in terms of information, the reason why I said go to Reuters, go to local newspapers, go and have a look at financial statements, have a look at whatever you can, is these sources can help you understand how information affects security prices. So by way of example, macro data, we want to understand how interest rates or changes in interest rates or changes in currency rates or inflation or gross domestic product, what effect that will have on markets. So that's macro data. We want to also look at accounting data in terms of companies' financial statements and to determine the health of a particular company. We also look at corporate finance. And so corporate finance develops various different asset pricing models. So some of these asset pricing models you definitely have covered, one of them being the capital asset pricing model, CAPM, the other being the dividend discount model, DDM, and there are various different types of other asset pricing models. And when you combine all these information sources will hopefully allow you to tease out relevant information that you can decipher and determine how is this type of information going to affect the price of the company in its future. And so the idea is that a lot of these information sources are public, right? And public information has an effect on security prices, but also private information has an effect on security prices. And not everyone has access to private information, but if you do, then that can also help you understand how the price of a security might move in the short term, medium term, or long term. And that's important. Now, when we talk about this next slide, trading is a zero-sum game. Well, what does this mean? Well, from a monetary perspective, dollars and cents, when we talk about trading as a zero-sum game, the answer is yes, because the total net gains of the winners will equal the total net losses of the losers. That's what a zero-sum game means. If there are only two people in the market, two traders in the market, and let's say Ruben is trading against Tim, okay? I'm trading BHP, my loss in BHP is Tim's gain in BHP, right? So so that's basically it, right? If I lose $100, Tim gains $100. So that's what trading being a zero-sum game refers to from a monetary perspective. Now, is trading truly a zero-sum game? If we think about the non-monetary aspects of trading, then I would say no, trading is not a zero-sum game. So in the example that I gave you, Ruben lost $100, Tim gained $100. But I lost $100, right, in trading BHP. Now, did I gain anything from that? Well, I could say, yes, I did. I learned from my loss. I lost $100, but I learned why I lost $100. So that's a cost of learning. I lost $100, but did I enjoy losing $100? Yeah, I enjoyed losing $100 because that's the thrill of gambling, right? So I gained from that loss in a non-monetary way. So I could say that's a positive gain for me. Now, from a financial intermediary perspective, and we went through various different brokers. We went through CommSec, Interactive Traders, Macquarie, CommSec and Interactive Traders, and someone mentioned eToro. But the idea is that there are many other different types of online brokerage companies out there. What do I want to talk about here? Do these people lose money? Do these people lose money? Answer, no. Financial intermediaries never lose money. It doesn't matter whether the market's going up or whether the market's going down. These financial intermediaries always receive a brokerage fee. It doesn't matter whether Ruben lost money. Ruben still pays a brokerage fee to the financial intermediary. It doesn't matter whether Tim made money. Tim still pays a brokerage fee to the financial intermediary. So the financial intermediary never loses money. But it is in the financial intermediary's interest to ensure that they would prefer financial markets are rising as opposed to falling. Because when financial markets fall, less people become confident in trading in financial markets. And so if there's less people in financial markets, then there's less opportunity to make revenue through brokerage commissions. So the next question, why trade? Well, I introduced that concept in the first part of today's lecture. The concept being that most people who trade are profit motivated in terms of why they trade. They trade because they want to make money. Now, the question is, and this is a very important question for you, especially in today's modern financial markets, is why do you trade? What is the motivation for you to trade or invest? That is, let's say I'm talking about myself. And let's talk about Tesla, which is electronic. What is one of the things it does is produces electronic cars. I want to invest in Tesla. There's two different perspectives, okay? There's two different perspectives. Ruben wants to invest in Tesla because I believe that Tesla is trying to revolutionize the world by producing environmentally friendly vehicles that will help reduce carbon emissions in the world. So I want to invest in Tesla and I want to be a long-term investor. As a result, I buy Tesla, okay? Because I want to help the company grow and I want the company to succeed in achieving that aim. Will I sell Tesla? Probably not. I will buy Tesla and I'll be a long-term investor. And only if I need to secure my unrealized profit will I sell it in the distant future. That's one. Number two, I don't care about Tesla. I don't care whether it's environmentally friendly. I don't care about the financial statements of the company. But I know that I've seen that the prices of Tesla can be quite volatile, can go up and down pretty quickly. So I'm just interested in the volatility of that particular company's stock price. And I'm just going to trade around that company's stock price quickly. So I want to trade now and sell within the hour and hopefully make a quick gain. That's why I want to trade Tesla. Okay? So there are two different perspectives in relation to why you trade, in relation to Tesla. But both those individuals, the one that's interested in Tesla because of its carbon emission reducing goal, or the one that's trading because of volatility, all are profit motivated. They have a different time frame as to when they want to realize their gain. Two, some traders can be utilitarian in nature. Utilitarian is that I'm not trading solely for profit. I'm trading for other reasons. And so these traders can say, right, I just want to buy this stock because by buying this particular security or stock is going to enable me to reduce my risk in my portfolio. Maybe I want to barter. So I want to swap one asset for another because I just need that asset right now. And for the purposes of my everyday living standards, maybe I want to hedge and reduce my business exposure. Maybe I'm trading because I get entertainment from trading and I'm a gambler. Maybe I'm a profit motive. Maybe I just want to learn from trading. And I just want to, like you, maybe you're a fledgling and you've never traded before, but you want to learn from trading and you want to set up an account and just start trading and learning from doing it in real life. Maybe you want to make a loss so that that loss can be used to try to minimize your tax from other income that you've earned. Whatever the case is, you might have a different trading style. So you might be a long-term investor. Sometimes long-term investors are referred to as mom and dads, where you can hold a particular security for years. Maybe you want to be a day trader, a swing trader, a position trader, a scalper, an arbitrager, where you're trying to capitalize on mispricing opportunities between two or more similar securities. And all these different traders have different holding periods, which you can have a look here. Maybe you want to be a fundamental trader. So this is what corporate finance teaches you. Corporate finance teaches you have a look at, determine what the true value is based on fundamental information by looking at balance sheet, profit and loss cash flow statements, and other pieces of information sources to determine what the true value of the security is, compare that to the current market price, determine whether it's undervalued or overvalued, buy an undervalued security, sell an overvalued security. Maybe you want to be a technical trader, which the university and academics don't encourage, but technical traders basically look at historical share price and trading volume information. And from using that information, they try to use various different models to determine what the short-term price trend of that security will be based on historical data. Quantitative traders basically use various different asset pricing models that they come up with to try to determine what the price of the security should be based on those mathematical and statistical models that they arrive at. So a specific security might have a specific asset pricing model that determines what its true price should be, and you can potentially use that model to make money. Hybrid traders use a mixture of fundamental, technical, and mathematical and statistical models in order to determine what the value they believe the security is, and then trade accordingly. In terms of application styles, you can be a mechanical trader or you can be a discretionary trader. A mechanical trader is one that is very robotic in nature, where you can use algorithmic trading. So you have preset rules as to when you buy and sell securities. You might say, if the security goes up by 10%, I sell it. If the security goes down by 10%, I buy it. So that's a mechanical filtering trading rule, not based on anything, but just based on a rule that you've developed. Discretionary traders are those that will buy or sell securities based on will be based on their discretion. Based on a feeling. They think the security price is going to go up, so they buy the security. They think the security price is going to go down, so they sell the security. That thought process as to whether the security is going up or down may be irrational, completely based on irrational exuberance, or it may be due to some form of private information that trader believes they have, which others do not. Markets and platforms. So whatever market you trade in, whether you trade equities, fixed income, derivatives, cryptocurrency, foreign exchange, commodities, and so forth, every security has a particular trading platform that you can use. Most retail traders have the ability to trade any security in the world today because of electronic trading. If I can ask you just to put yourself on mute, please, as I'm hearing your voice, and all of us can text. Okay, so having said that, let's have a break. It's 11:08 now. Let's come back at about 11:15. Let's have a break, and we'll start on this various different order types, and then we'll conclude today's lecture. So I'm going to stop my video, but by all means, I'll still be here. So if you have any questions for me, just either talk to me or put a question on the chat window. I'll see you at 11:15. Okay, so talk to you soon. Bye for now.
Hey, Ruben, just a quick one.
Yep.
So just with regards to group formation, how does that actually functionally work? Do we nominate who we're working with and then sort of send you an email for it, or?
Yeah, so probably let's say by week 3, ideally, you'll have the ability to find who you want to work with, whether it be within your tutorial or outside. And then you'll send, I'll put a form out that you can just, put your names in the form, sign it, give it to me, and then we'll know. Or actually, maybe there's an electronic way of doing it too. And then that way we'll know who's formed a group by week 3. For those people who haven't been able to form a group for whatever reason, by week 3, I will randomly assign them into a group with a relevant number of people.
Cool. And I know we're sort of using the trading simulator for it, but can you give us detail on sort of how that fits together? So are we going to be doing our own trading activities and then sort of combining our learnings, or are we all going to be trading under the sort of same simulator in the group?
Yeah, so effectively it's, I haven't actually thought about it too carefully, but what's going to happen is, well, that's a good question. Ideally, everyone individually will be trading, because if it's a group exercise, it's hard to learn from an individual perspective. So everyone's going to learn. Some people, like in your group, for example, Lachlan, some people are going to make mistakes and make losses. Some people make gains. But the idea is that you're going to learn as to how you make the gains and how you make the losses. And together, you can draw from everyone's information what you've learned in it as a total from an overall perspective. So, for example, okay, so for example, we might have this game about, okay, when you put a large market order into buy to buy a particular quantity of securities, and you need to buy it within 10 seconds. but you can't, you buy it within 20 seconds. So why has that occurred? Has that occurred because you've been too slow in pressing enter? And so other people have beat you in terms of price time priority? Or are there other reasons that by buying a large quantity of shares within 10 seconds, what has been the additional cost of doing it for you versus if you bought it in 20 seconds? So it's these very simple exercises that we go through in class that you get to learn when you do it. When you're trading, the security that's being trading might be very slow. So you can actually execute your order very quickly, but at the same time, there might not be enough depth in the market to buy everything that you want. And you just learn all these little things, right? And so and this is a very simple exercise I've just mentioned to you, but the idea of when you write up your assignment, so let's say one of the questions is, what's market impact cost, or that's what I've effectively discussed. You can describe that based on your maybe real life experience. And then, as we go on the semester, we might talk about algorithmic trading, and I want you to program something, a very simple program that allows you to automatically buy and sell things based on your filtering that you have programmed in whatever. Let's say I'm going to use VBA Excel, but the idea is with Rotman Interactive Trader, which we haven't gone through yet. We might not have time to go through it today in today's class, but I'm going to do maybe a 30-minute video as to how to set up your Rotman Interactive Trader Citrix application. I want you to log in before week 3, so hopefully do it week 1, week 2. See whether there's any technical issues. There's going to be a trading game that is running on a loop. So it means that anyone can log in whenever you want. If you want to log in at 1 a.m. or you want to log in at 3 p.m., log in whenever you want and just spend a little bit of time to understand the little buttons that you have to press, so that when it comes to week 3, okay, I know what to press, and the instructor's still going to go through it with me, but at least I've had the chance to do it beforehand and figure it out.
Cool. Thanks for that. And so I guess distilling that, the group element of the project is just synthesizing our various different learnings into a final report.
Correct.
Yeah, cool. Unreal. Thanks very much.
No worries.
Hey, is there any chance I can ask a real quick question?
Yep, sure. 2 Lachlan's, okay.
Yeah, Lachlan as well.
Yeah.
Not major, just interested. You mentioned that the faculty is not so keen on technical structures. Is there any reason
training?
Why? Yeah.
Yeah, because at the end of the day, now let me clarify, before I give my answer, let me clarify this by saying I don't think that there's anything wrong with technical trading, right? So let me say that first. But as an academic, we always talk about market efficiency, and we teach that as though it's the gold standard. So that came out in the 1960s, right? The efficient markets hypothesis. Now they talk about adaptive markets hypothesis and so forth. But the idea is that if we taught technical analysis, and we would go against efficient markets hypothesis by saying that you can consistently make money by analyzing historical data, suggesting that markets are not efficient, right? And so that's why probably most universities don't teach that. But if you go to any library, or even get a lot of people working in trading houses and banks, they use technical analysis, right? They use whatever information they can to try to get a glimpse of what the future direction of the price will be, right? Get an indication of it. So people do use technical analysis. They do make money from it, but I would say have a general understanding of everything. Because at the end of the day, if people use historical data to get an indication of future price direction, then they can also get an indication of how the demand and supply schedule will change based on order depth. And that's important too. So as a trader, if you're going to be a serious professional trader, you're going to use any information you can, because not everyone believes in efficient markets hypothesis, and people will trade accordingly. Yeah.
Thank you.
You're welcome. Okay, so it's 11:16, so it makes me begin again. So I'm going to just grab some water, and we'll start. Okay, so one of the things to talk about is, actually, before we start, there are 119 people in the room. What I failed to mention, and this is no big deal today, but for tutorials, is going to be really beneficial, and I'm not even going to encourage it. I'm just going to say do it. Can you please put your face profile picture on your Zoom profile? I know that some people can't put their cameras due to bandwidth issue, which is fine, but from a tutor's perspective, it's always really good to for the tutor to be able to see who they're speaking to, and then it can also just allow other people in the class to know what you look like, because we like seeing faces as opposed to blank screens. And the second thing is also do it for the lecture as well, for maybe next week's lecture. If you don't mind just putting your profile picture face on it on your Zoom, that would be awesome. Okay, so orders and order properties. Let's talk about this now. You know, if you're okay, so orders and order properties, what are they? Well, at the end of the day, what's an order, right? And at the end of the day, an order is just an instruction, right? An instruction to buy, an instruction to sell, an instruction to buy immediately, an instruction to buy or sell at a particular price point, and an order and an instruction to say how long that order is going to remain on the trading platform. Is it going to remain on the trading platform for 10 seconds? Is it going to remain on the trading platform for the remainder of the trading day? If we're talking about equity securities, at least in Australia, do have normal trading. And normal trading is where most individuals can buy and sell with others. And normal trading on the ASX is from 10 a.m. to 4 p.m. Other exchanges have different trading hours. Now, in terms of these words, so all of you, you know, when I talk like this, I think you guys don't know what the heck I'm talking about, or you might think I'm talking about really simplistic stuff. But the idea is I talk about it because some people might need to have a recap or don't know what it means. So for those who do know what it means, you know, just bear with me. A bid is just buy, okay? It's an instruction to buy, a bid. An offer, sell. Another word for an offer is ask. The best bid is the best buy price. So the best buy price is the highest price, right? If I want to buy a sandwich right now and the sandwich is worth $10, well, if I say I want to buy the sandwich for $12, well, that's the best buy price, right? Because it is the highest price where the seller would rather get $12 for the sandwich as opposed to $10. Now, the best offer price is the best sell price or the best ask price. Now, the best offer price is the lowest possible price, right? And that's the best offer. Now, the best bid and best offer change over time because prices dynamically change over time. The NBBO stands for the National Best Bid and Offer, okay? And it's a term that is coined in the United States. So in the United States, you have securities that trade on multiple exchanges. So in the United States, you have, let's say if we're just talking about equities, okay? In the United States, you have, for example, IBM or Microsoft that trades on NASDAQ and trades on the New York Stock Exchange and other regional exchanges. And the National Best Bid or Offer basically looks at all the prices from all those multiple exchanges and then says what's the best bid for Microsoft, what's the best offer from Microsoft, where you get it sourced from all the multiple exchanges. The bid-ask spread is effectively the best ask minus the best bid, and that gives you a spread, which represents the transactions cost. A quote is just like that. If I want to buy a Porsche, I don't know why I'm thinking about a Porsche. I think it's because my friend wanted to buy a Porsche 911, but they bought a McLaren instead. Now, the idea is that a quote, let's say a car dealer gives you a quote and says, if you buy this McLaren today, the price of this McLaren is $350,000. That's how much you'd have to pay me if I'm going to buy this McLaren. And that quote is just that. It's soft. It only applies for a certain period of time. So if I come back tomorrow to that dealer and say, look, I like your quote, I'll buy the McLaren for $350,000. That dealer might say, no, I'm sorry, but that quote only applied yesterday. Today, the price of the McLaren is now $400,000. So quotes are just indicative in nature. Firm quotes tend to be more stable and long-lasting in nature. Firm quotes apply for a longer period of time, while soft quotes apply for only a limited amount of time. In terms of this particular diagram here, we have what's referred to as an order book for security trading on the Australian Securities Exchange, being Commonwealth Bank. So in terms of this particular security, let's say this order book, so this is an order book. An order book is visible. So if you went to one of these trading platforms such as CommSec or Interactive Brokers or E-Trade, you would be able to see an order book for a particular security at a particular point in time. Let's say this order book is for CBA at 11:24, 15 seconds AM. So this order book is what it looks like at 11:24:15. Now, what's important to note is that what's important to note is that this represents the bid schedule, order book schedule, and this represents the offer or the ask schedule. Okay, so having said that, what I want to say to you is that, if I can make it bigger, is that this represents the best bid price. So at 10:24:15 AM, the best bid for Commonwealth Bank is $82.79. At 10:24:15 AM, the best ask price is $82.80. So what does this actually mean? Here, we say that there are 14 people who want to buy 320 CBA shares for $82.79. Here, we're saying there are 13 people that want to there are 13 people that want to sell 2,055 CBA securities at $82.80. Now, one of the things to be aware of is we know that the difference between the best ask and the best bid is the spread. So in this case, $82.80 minus $82.79 gives you the spread, 1 cent. The spread is, a transaction cost. Now, when you have orders which are market orders and limit orders. These are the two general orders that you can submit into an order book. A market order just means you want to buy it right now. I want to buy a certain amount of shares right now. I want to buy or sell a certain amount of shares right now, immediately. Limit order just means I want to buy or sell a certain amount of shares at a particular price, and I'm willing to wait, and I'm prepared to wait, So when we talk about this particular order book, if I wanted to sell 10 shares of CBA immediately, I would have to pay $82.79, right? I would have to be prepared to go from $82.80 to $82.79. I would have to be prepared to cross the spread. That is, I would have to be prepared to cross the spread and pay 1 cent in terms of transactions cost in order to sell immediately. Conversely, if I wanted to buy 10 shares of CBA right now, I would have to buy it for $82.80. That is, I would have to be prepared to cross the spread from $82.79 to $82.80 and pay 1 cent to buy 10 shares of CBA shares immediately at $82.80. Okay? So that's what the spread really refers to. Now, in terms of the idea of price time priority, because I still want to talk about this, I want to talk about this idea of price time priority whilst we're still having a look at this book. So most of you should have an understanding of what price time priority is, but if you don't, I'm going to use the analogy of lunch, because I'm thinking about lunch right now. So by way of example, let's say I want to go get a sandwich from the local cafe. Now, before I give that analogy, think about this bid schedule think about this bid schedule and offer schedule as a queue, as a line. So let's talk about the bid schedule, because I want to buy a sandwich soon. Now, if I go to the local cafe, right, I'm going to be able to be first in the queue right now because it's around 11:30 in the morning. Unlikely that people are going to be in the queue lining up for lunch. So I am probably going to be first in the queue based on time. But if I'm delayed and I come at 12:15 in the afternoon, then I might have to line up behind others because I wasn't the first to arrive at the sandwich shop. So instead of being first in the queue, I might be number 14 in the queue. And so I have to wait in order to get my sandwich. So that's time. That's time. Now, if I'm number 14 in the queue, I might say, you know what? I don't want to be number 14 in the queue. I can't wait to get my sandwich. I want to eat my sandwich right now. I want to buy it right now. So let's say the sandwich is worth $10. I might yell out and rudely to the cafe owner, I might yell out and say, look, I'll pay $20 for one sandwich, right? And the cafe owner says, sure, come up, give me 20 bucks, I'll give you the sandwich. So I can be in front of the queue based on bidding a higher price. So it's price then time priority. Price then time priority determines where you are in the queue when it comes to either the bid schedule or the offer schedule. Okay, so that's my hopefully good analogy, but it might be a shitty analogy, I'm not sure. Whatever the case is, let's talk about it on the next slide. So when we talk about price time priority, it's a principle of price time priority refers to how orders are prioritized for execution. Orders are first ranked according to their price, where the highest price bid is ranked number 1 in the bid order schedule, and the lowest priced ask is ranked number 1 in the ask order schedule, and orders of the same price are then ranked depending on when they were entered. Okay, so you can read this if you understand this, and great. If you don't, then let me know. Minimum tick size. Okay, so minimum tick size is just understanding the rules of the game. Minimum tick size is talking about the minimum price increment you can quote in the market, and depending on the prices, you get various different minimum ticks. So if your stock is above $2, the minimum tick is 1 cent. If it's below $2 but higher than 10 cents, it's half a cent. And if it's lower than 10 cents, then it is 1/10 of a cent as the minimum tick. So it's the minimum price increment that you can move your price when you put a limit order into the book. So we're going to talk about the minimum ticks very quickly, but these are limit orders, right? And the way to describe limit orders potentially is to just look at this particular schedule. So note that the schedule that I showed you before. Oh, what have I done? Oh, okay, hang on. Sometimes it happens. The schedule that I showed you before looks like this, right? For CBA. Most people, this is called a book style schedule, and most trading platforms will show it in this particular style. But I'm going to show you the schedule in terms of a ladder style, and this is a way of viewing the schedule, the order book, in terms of a ladder style. Now, let's say I'm talking about a security A, B, C. Now, on a particular time. Now, these are limit orders. Limit orders are prices that, let's say the limit order was, for the purpose of today, let's say the limit order was, let's put $2 in front of it. I should have put $2 before, but I didn't. Okay, so in this case, Henry wants to buy 100 ABC shares for $2.08. Dave wants to buy 250 shares for $2.06. Henry wants to buy 50 shares for $2.03. Jack wants to sell 20 shares for $2.09. Mike wants to sell 80 shares for $2.11. Jill wants to sell 100 shares for $2.14, and Toby wants to sell 500 shares for $2.19. All of these represent limit orders. In an order schedule, you will never know who the people are. You'll never know it's Toby, Jill, Mike, Jack, Henry, Dave. Right? You'll never know who they are, right? Because they don't want to reveal that information, because that in itself has information. But for the purposes of this description, that's what limit orders are. The difference between the best asked and the best bid is 1 cent again. Now, in terms of the minimum tick, what I want to highlight is that, remember, the minimum tick is 1 cent. So let's say Dave wanted to improve, let's say Ruben comes into the market and wants to buy 50 AB. Ruben comes into the market and he wants to buy 50 ABC shares, but wants to be above Dave, right? Ruben would then put a limit order of potentially $2.07 at 50, and that would be Ruben. And Ruben now would be sitting behind Henry at $2.07, wanting to buy 50 ABC shares. Now, remember, the minimum tick was 1 cent, for stocks priced above $2. So Ruben could not put a price of 2.065 at 50, Ruben. So Ruben could not do this. Okay, he could not put a limit order at 2.065 because Ruben would have to put an order which meets that rule of a minimum tick, that minimum tick being 1 cent, right? So that's something to be aware of. Market orders. Market orders is that, as I said, you want to buy or sell something quickly. Now, with market orders, because you want to buy and sell something quickly, when you want to buy a lot quickly, you might buy more than what you want to buy. So, for example, let's say in this particular case, let's say Ruben wanted to buy 150 shares, ABC shares, using a market order, and this was a buy market order, right? If Ruben wanted to buy 150 shares immediately, then he would buy 20 shares from Jack at $2.09. He would buy 80 shares from Mike at $2.11, and he would buy 50 shares from Jill at $2.14. So large impatient orders may have prices that cause market impact, i.e., I'm buying 150 shares for a lot more than what it's currently trading at. Okay, so thus you're buying those shares for potentially a higher average traded price than what others are buying those shares for. And execution price uncertainty exists because you don't know at what price you will stop at. So you could buy those large quantity of shares or sell a large quantity of shares at a price which is significantly different, higher or lower, than what the current prevailing price is. With market orders, there's also the idea that you pay half the spread per transaction on a round trip trade. Now, in relation to this, what's a round trip trade? A round trip trade means that you buy and sell the same quantity of shares immediately. So let's say I buy 100 shares of BHP and then I sell 100 shares of BHP immediately. So in this particular case, let's have the best offer being 102, the best bid being 100. The spread is 2. Now for a round trip trade, so if I buy immediately, I buy at the best offer price, 102. That's the first transaction. And I sell immediately the same quantity of shares. I sell at the best bid at the price 100. That's the second transaction. Now remember, in the cost of immediacy, you bought and then sold. So have you made a profit? In this case, you've made a loss. The cost of immediacy, the loss is $2. And that's for 2 transactions. So the cost of immediacy per transaction for a round trip trade is half the spread. In this case, $1. And so that's the reason why we have this statement, you pay half the spread per transaction on a round trip trade. Now, incoming market orders may encourage price improvement in the lit market. Now, we'll talk about the lit market very quickly, but before we do so, now, when we have price improvement, what does price improvement mean? Price improvement means that you lower the current spread. At the moment, the current spread is 103 minus 100. So the current spread is 3. Now, by having incoming market orders, that may encourage people to improve the best bid from 100 to 101, or improve the best offer from 103 to 102. So market orders can encourage price improvement. Now, when we talk about the lit market, what are we talking about? The lit market can also be referred to as the downstairs market. So we have the lit market or down. Oops, what just happened? Downstairs market, and we also have versus the upstairs market. Also, it can be referred to as a dark market. So to give you a quick analogy, the downstairs market is where most retail or the lit market, lighted, visible. You can see the order book, lighted. So the idea of the downstairs market is where most retail traders participate, and they generally execute orders which are less than $1 million in value, and they can see the order book. The upstairs market is where trades which are in excess of $1 million usually trade, and this is where institutional traders participate. And the upstairs market is dark. The order book cannot be seen as clearly. Okay, so very important in relation to distinguishing that. In terms of a casino, perhaps the best way of describing it is that on a casino floor, it's downstairs market where all the general public come to gamble and play games. If you're talking about the high rollers go upstairs in the market and are invited to come upstairs to play the game. So maybe that's one way to easily distinguish it from that type of analogy. Now, in terms of marketable limit orders, remember I said marketable market orders have price uncertainty. Well, you want to have price certainty, but you want to execute your order quickly. And so you would execute what's referred to as a marketable limit order. So to give you an example, again, with the same example that I used beforehand, let's say I did put $2 here, so I'll just put $2 here again to keep the example the same. Let's say Ruben puts an ABC, Ruben wants to buy 150 shares using a market order, but with a limit price. Whoops. Have I done that properly? If a limit price of $1.13, i.e., I want to execute this buy market order, but I don't want to pay any more than $1.13. So Ruben would buy 20 shares from Jack at $2.09, would buy 80 shares from Mike at $2.11, and then the market order would stop because I would only be able to execute 100 shares of my 150 shares that I wanted to buy, but I wouldn't buy any more because I put a limit price of $1.13. That's a marketable limit order that gives me price certainty. So we know what marketable limit orders are now, hopefully. Stop orders. Now, stop orders are just that. They are used to limit your loss. You put a stop order to limit your loss in a trading strategy, and stop loss orders can destabilize markets. So I'm just going to give you one example, and you can have a look at the rest later. Let's say I put a sell stop order. So let's say I buy 100 units of ABC at $100. So if I don't want to lose more than 10%, then I want to, if the price were to fall to $90, then I would lose more than, if it falls below $90, I would lose more than 90%. So I put a stop order or a stop price at $90. Now this means that when the price hits, when the price of that security fluctuates and hits $90, then what happens is that straight away, the order will activate to a market sell order. So I get out of that stock quickly at $90 and limit my loss to 10%. But the problem of doing that is that the market sell order will destabilize the market. It will push the price push the it will exert a downward pressure on the price, which may push the price further down more quickly. So stop orders can have the effect of destabilizing prices more quickly. Market if touched orders are the reverse of stop orders. Market if touched orders stabilize prices. So by way of example, let's have a look at a sell market if touched order. So in this case, let's say we put a touch price of $110. So let's say currently the current offer is 100, the current bid is 99. Let's say the price starts to increase. Okay. Now, if the price increases to 110, then if you put a sell market if touched order, then there will be, when the price hits the touch price of 110, a sell market order is activated, and that has the effect of pushing down the price. So when you have a volatile stock, the company may decide to use sell or buy market if touched orders to try to minimize that volatility. You have also what's called tick sensitive orders. Now, tick sensitive orders is talking about the last price change. So if the last price change is positive, if the trade price goes from $10 to $10.01, it's an uptick. If the price goes from $10 to $9.99, it's a downtick. Now, sometimes orders have to be specifically catered for upticks or downticks. So in some exchanges, when you short sell and put a short sell order, then you can only short sell on uptick. And so you have to put that condition when you place a short sell order into the market. Market not held orders are just that. Let's say I have $10 million and I don't know anything about markets, but I have a friend who's a broker. And I just say to my broker, here's $10 million, make it grow. Well, and I say to that broker, you have market not held orders. What that means is that the broker has discretionary power to submit orders for any security based on what he or she believes that security will do. So if that broker has information that is short-lived, then the broker can quickly act on that short-lived information without calling the client to ask that client whether they should buy or sell that security and get authorization. So that broker has ultimate power. Now, in terms of the last page we'll look at, orders also have order modifiers. Some of these orders modifiers include immediate or cancel, all or none, fill or kill. As you can understand, the trading industry has a lot of colorful language when they describe what's happening. And I suspect using colorful language makes the trading industry look and seem more sexy than potentially it is. But the idea is that you need to understand what it means. So the idea is, let's have a look at this one first. Buy 30, limit 109. Let's talk about ABC. So buy 30, limit 109. That means buy 30 ABC securities for no more than $1.09. The second one, buy 30, limit 109 IOC. What does this mean? It means buy 30 ABC securities for no more than 109 cents, right? For no more than 109 cents right now. Buy less than 30 shares is okay. Okay? So that's what it means. You can buy less than 30 shares, but it has to be right now for no more than 109. Let's have a look at the third one. Buy 30, limit 109, all or none. So it means, what this means is buy 30 ABC securities for no more than $1.09. The condition is that you need to buy the entire 30 shares, right? You can't wait. You can't wait in relation to all or none. Now, the idea is that it doesn't have to be bought immediately in relation to this. This can be done. This can be done across the entire day, for example. So, but the idea is that when you do buy 30, you have to buy 30 shares in its entirety. You can't buy 10 shares, then buy 15 shares later, then buy 5 shares later. It has to be done in one transaction. And the last one buy 150, limit 111 FOK. What this means is that you buy 150 shares for no more than $1.11 right now. If I can't buy 150 shares, cancel the order. Cancel the order. Okay? So that's what these relevant modifiers refer to. And it's something that you should just be aware of. The modifiers immediate or cancel, all or none, fill or kill seem to be quite aggressive in the way they're described. But then because trading has typically been dominated by males over many, many years, I suspect that's the reason why these descriptors are potentially more aggressively worded than what they might be otherwise if it was less dominated by males. But with that said, as I said, with Rotman Interactive Trader, we're not going to be able to go through it today, but I'm going to place a video for all of you to have a look at in your own time, and also instructions whereby you can use the Citrix platform, which is a platform that you can use the software irrespective of your computer. So whether you have a Windows-based computer or whether you have an Apple-based computer, you can still access the Citrix platform through the web, and that will allow you to play the game appropriately. So with that said, that's all for today. For next time, please do include your profile pictures on your Zoom so I can see who you are. I mean, I love seeing who people are and talk to them. So please do so. And otherwise, if you have any questions, my tutors are pretty easygoing. I'm pretty easygoing. So please ask questions where you want to ask questions. Otherwise, if you have any questions for me, please ask me. You can ask me just by unmuting yourself, or you can go on the chat page. Yes, the recording of the lecture will be provided on Canvas, and yes, the lecture is being recorded and it will be uploaded on Canvas, probably by today. How many people are there in a group? I think there are 4 to 5. Yes, the group can be. People can form a group from outside their class. Yes, Olivia, the answer is yes to your question. Could we form the group including students both RE and CC? Yes. Yep, so a lot of questions about the group assignment. So yeah, by week 3, I'll put some information on the announcements, but by week 3, you should be able to form your group. If you haven't formed your group by week 3, then I will randomly assign you to a group. I'll provide more information about how to form the group on Canvas, but probably that would be easier to form the group on Canvas. Yes, 100%. You should practice trading in Rotman Interactive Trader before your classes begin on week 3. So I'm going to provide you with instructions on that by the end of let's say by the end of this week. And so please follow my instructions, and then hopefully you can practice Rotman Interactive Trader by yourself to familiarize yourself with the software and the various different buttons that you need to, as to how you submit orders and so forth. Are there any other questions?
Professor.
Hi, Jitul.
Yeah, I have a question. Just curious. Just now you did mention about the arbitrator, right? So is there any specific company that hire this arbitrator, or most of them working individual?
Yeah, so it's a both. So if you're you could be a professional trader, for example, where you're trading using your own money, right? And that's called proprietary trading. And so the idea is that as a professional trader, you might identify mispricing opportunities between 2 similar securities and trade accordingly. You also might work for a large trading house or investment bank, so you're an employee, but your ultimate aim is to make money for the bank. So you also might engage in arbitrage trading activities. So arbitrage arbitrage trading, in fact, came about when an investment bank sort of detected this type of trading was profitable. And there was an investment bank at the time, which now doesn't function anymore, called Solomon Smith Barney. And Solomon Smith Barney, the people there were the people who came up with arbitrage trading, at least in equity securities. So you could be anyone, you could be a retail trader, but the thing with arbitrage trading is that it's very important to be able to execute the trades at precise times. And so you have to invest a lot of money in terms of infrastructure that allows you to execute your trades at precise times, or allows you to submit your trades very quickly. Because if you don't, then that arbitrage trading strategy can, if you thought that you're going to make a gain, it's likely that you're going to make a loss. Because arbitrage, especially on equities markets, the profits that you can make are very, very small. And so the way in which to make economical profits is to trade very large quantities of securities. And generally, people can only do so if they have a large capital base behind them. I hope that answers your questions at all.
Yep. Thank you so much.
Sure. Any other questions that anyone might have before we end today's class? Okay, I assume no more questions. Well, on that note, thanks very much for coming today. Please attend tutorials and please attend lectures. It's really important because you get to ask questions directly to your tutors or to me, and you get to learn a lot more. And we talk about other things that we might not cover in a standardized prescriptive classroom setting. So if you have any questions, by all means, please ask my head tutor or myself, and please actively use the Ed discussion board, because sometimes you can learn amongst your cohort and get to know your cohort in a more better and meaningful manner. So on that note, thanks very much for coming. I will end today's class, and I will say have a great weekend.